You're not going to believe this. Mortgage rates hit 8% as Treasury yields continue to increase. Good morning, everybody. Thank you so much for checking the channel out today. My name is Agabus. This is your financial education channel, and let's get right into it. Today we've got an article from Wolf Street. 30-year Treasury yields spike fast, 5%. 30-year mortgage rates hit 8% as mortgage applications plunge. Obviously, real estate should have a little bit of a pullback because it is way more expensive to buy the same home today as it was even a year ago. Today, it's the 30-year Treasury yield that pierced the 5% line. It currently trades just over 5% at 5.02, the highest since August of 2007. These long-term yields above 5% are an indication that a form of normalcy is gradually being forced upon the bond market by the resurgence of inflation and by the belated realization that this inflation isn't just going to go away on its own somehow. This is a huge regime change, and after years of Fed's quantitative easing and interest rate repression, and all prior assumptions are out the window. You can see here that the 30-year yield is at all-time highs going back 16 years now. Also, the 10-year yield has jumped to 4.92% at the moment, also its highest since July of 2007. It seems the long-term Treasury market is gradually coming out of its delusion about inflation and normalizing interest rates after having spent 18 months believing in the hype about a Fed pivot and rate cuts to something like 0%. That would be forced on the Fed by a steep recession with lots of forever quantitative easing to follow. Instead, consumers are earning lots of money and are spending like drunken sailors. Businesses are spending and investing too, and the government is the biggest drunken sailor of them all, further boosting the economy and throwing more fuel on inflation. The article continues and says that this deficit spending by the government has to be funded by piling enormous amounts of Treasury securities on the market that need to find buyers. Yield solves all demand problems by rising until demand emerges. And that's in part what we're seeing now. To take a deeper dive here, higher yields mean lower prices. So this return to normalcy has been dishing out huge losses to investors who had bought long-term bond funds or long-term bonds in the era of quantitative easing. Investors that own these way underwater 30-year bonds outright can choose to hold the bonds to maturity at about 2050 when they'll finally get all of their money back and collect 1.5 or 1.8% along the way. Again, reminder, with bonds and interest rates, the relationship is as interest rates go up, as they have, the value of your bond goes down. The article continues and says investors that bought during quantitative easing are in a world of hurt. The iShares 20-plus year Treasury bond, which focuses on Treasury bonds with a remaining maturity of 20 years or more, fell another 1.6% today at the moment and has plunged by 51% from the peak in August of 2020. Can you imagine holding a long-term bond, which is more conservative, generally speaking, for a long term, and within only a couple years, the bond has lost 50% of its value? That's crazy. And which had marked the peak of the 40-year bond bull market that had turned into the biggest bond bubble ever. 8% mortgages are now here to stay. The 30-year fixed mortgage rate kissed 8% today, according to the daily measure by Mortgage News Daily. If mortgage rates stay here to enter the weekly average at the level, it would be the highest since 2000. The good times are coming back, aren't they? And what does all this have to do with the housing market now? Well, mortgage applications to purchase a home have been on a steady collapse track, and in the last reporting week slid another 6% from the prior week to also hit new multi-decade low, and they're 48% below the same week prior to the pandemic in 2019. Mortgage applications to purchase a home are an indication of where home sales volume will be over the next few months. And home sales volume has already collapsed, and mortgage applications indicate that it will continue this trend. In other words, the Fed, who has had repressed mortgage rates, have triggered a huge bout of home price inflation, and the surge in mortgage rates now started to unwind it. Mortgage applications to refinance a home also plunged 10%. Obviously, if interest rates are higher, the chances of refinancing are much slimmer. Most of the refis, though, are cash-out refis. Non-cash-out refis have essentially vanished. They're down 97%, like I just mentioned, from 2019. So the mortgage industry is coming to a standstill, it sounds like, according to the article. Here's another one. This article is from ZeroHedge.com from Tyler Durden. U.S. existing home sales tumble to the weakest in 13 years. And in particular, first-time buyers have historical lows, with housing affordability at its lowest since the early 1980s. Hashtag silent depression. As supply suffers with housing starts slumping and mortgage rates continuing to surge, it's no surprise that analysts expected existing home sales in September to tumble 3% month over month. Actually, or only tumbled 2% month over month. But that decline left existing home sales still down 15% year over year. Sales fell across the entire region. As we can see here, some of the largest losses for the price of homes have hit the East and West Coast market. The one in particular that shocked me was a 40% drop in the price of the sale for houses going between 0 and 100,000. Single-family home sales have dropped to its lowest since 2010. Condominium co-op sales also declined. First-time buyers made up a historically low 27% of purchasers, down from the month prior. However, cash sales represented 29% of total sales. That is crazy. Who has got cash to purchase a home outright these days? And then investors also made up another 18% of that market too. So almost half of the market is from cash buyouts and investors. The median selling price of the home, however, still went up from a year earlier, the highest September reading on record, pushing affordability even lower. But existing home prices are falling relative to new home prices. I don't know what to say on the real estate market. I have no crystal ball. Obviously, I'm just a guy reading the news on the internet. But tell me, what are your 2 cents? Do you think we're going to see another '08? Do you think we're going to do a soft landing? What does your crystal ball tell you? Drop a comment in the comment section below. As always, thank you so much for watching. As always, stay informed, stay inquisitive, and stay subscribed for more. We will see you tomorrow.